At 12:30 GMT on Thursday, all investors and traders will be on their toes as US GDP data hits the newswires. And to talk me through the possible ramifications of this mover and shaker, Michael Boutros joins me from the New York offices of FXCM. Michael, what are you expecting from this latest version of US GDP?
Well, we're expecting to possibly see an uptick in GDP. If you'll remember, the last print came in at 1.0%. It was revised. We were looking for a higher print, but it got revised lower to 1.0%. And second quarter for the final read here, we're looking for a print of 1.2. The call for a higher print is not really shared by me. I'm not sharing that view. I think we'll come in, if not 1.1, at least at a 1%. But it's really a negative read below 1 or below 1% is going to be the key factor to look for a dramatic risk-off environment to really be fueled.
So what are the real soft spots in the U.S. economy?
Part of it's the health of the consumer, right? So we see that consumer confidence, although yesterday's print was not as dismal as the one we received last month, the health of the overall consumer in the United States is weaker than anticipated. I mean, if we just look at retail sales, came in completely flat month on month, which was it's down from a 0.3 read, which in and of itself is weak already. But there's really a shake of confidence here where the consumer is really reluctant to go out and spend, which is why we're looking for Friday's print is going to be even more so significant with regards to personal income and personal spending, which are supposed to downtick again from 0.3 to 0.1 on income and 0.8 to 0.2 on spending. So it just goes to support the overall view that the consumer is really struggling and that we're seeing an increase in the slowdown, or the pace rather, of the recovery.
Can you talk me through the two potential scenarios if US GDP comes in below 1% and if it outstrips expectations?
Sure. Yeah, if we print below 1%, I mean, you're going to look at your classic risk aversion flows. So the dollar should actually be buoyed pretty well. We should see the dollar pretty well supported as investors really just jettison risk across the board and looking to move into lower yielding safe haven currencies. And with the Swissy situation being where it is now and the fears of continued intervention from the Bank of Japan, the dollar is really the chief beneficiary at this point of haven flows. So a weaker than expected print, or especially if we get a print below 1%, expect strength across the board with the U.S. dollar. So the Aussie dollar, Kiwi dollar would be the ones that would really take it on the chin as far as aversion flows are concerned to the downside. A stronger print, I really don't think we'd get too much of a reaction, to be quite honest. I think the market is in a place right now where there's just so many dynamics working into it. A stronger print might not really move markets too much.
Michael Boutros there, speaking to me from New York. Remember, every day the TV team brings you the economic calendar with a rundown of the day's events. On Thursday, we'll be hearing from Deutsche Bank about the state of the German economy. Goodbye for now.